What's up, YouTube? Welcome to the Boeckle Bros Channel. It's tax season. I'm Landon.
And I'm Jesse, and today we are covering our 3 must-know tax loopholes.
So before we deep dive into today's video, I want you guys to know that we're not CPAs or certified tax professionals, but these are some tips and tricks that we use within our business to save some money on taxes.
Right, we're really excited to share these because we find these 3 loopholes super valuable. So let's jump right in. So everyone's heard of the age-old saying, there's only 2 things guaranteed in life, death and taxes. And well, we can't do much about the first one, so let's jump right into helping you save money on your tax bill this year and every year in the future. First things first is paying your kids. I don't know if you've heard about this before, but you can actually pay your kids, and it's considered a standard deduction from the IRS. You can pay them up to $12,000, and the only stipulations to this loophole are your kids actually have to do some work for you, and you have to pay them into an account that's in their name.
Yeah, so the work that they have to do has to be kind of relative to their age, though, right?
I would say so.
So if your kid's a 12-year-old child working around the office, have them sweep or clean up the office a little bit, or have them file some paperwork for you. Make sure that the work that they're doing is relative to their age.
Exactly. That's really the only rule you need to follow with this one, but otherwise it's $12,000 right off your tax bill.
Lots of money to be saved there. So the second tax loophole we're going to talk about is a little bit more complicated. I'm talking about bonus depreciation. So depreciation is writing off the asset's value over time. So when it comes to bonus depreciation, it really helps investors with rental properties and income producing assets.
True. And all this means for bonus depreciation is you're just taking accelerated depreciation. You're just taking more depreciation in that first year of the asset's life.
Right, and one of the most common assets that you can depreciate is your car.
The car as an asset for depreciation is super common because you can take and write off the full value of the car in the first year of ownership. Now you can actually do that whether you finance the car 100% from the dealership or you bought it outright, which makes it super lucrative.
So the really big difference maker is taking bonus depreciation on rental homes.
Totally.
Any improvements made to rental homes, such as new appliances, new floors, cabinets, countertops, any major upgrades or materials utilized for improvements can be bonus depreciated because they have a much shorter lifespan than a typical home, typically 5 to 7 year lifespan. So what's that mean? That means if you spend $10,000 for new cabinets in your rental, you can write off the full $10,000 in that first year.
That's a $10,000 savings on your tax bill this year.
As opposed to the typical property, which is depreciated over its lifespan of 27 and a half years.
So all you can do for this year is take 27 and a half fraction of your house and depreciate that for this year. So what's really cool about all the improvements is you can bundle them all together and write off that full amount this year.
Another huge savings on rental properties. So the third tax loophole, and a really creative one,
it's my favorite one,
is the Augusta rule. And the Augusta rule was created around the Masters golf tournament, which is super cool.
Yes.
And what the Augusta rule is it states that you could rent your personal property out to a business for 14 days a year without having to report the income on your personal returns.
So you get additional income from that rental, and your business, when it rents out the property, gets an additional expense to reduce its taxable liability.
So one of the main questions is, well, how do you determine how much you could rent your home out for per day? And it's simple. You could use local to your market comparable rental facilities for business meetings, conventions, or event spaces, and compare those facilities to your home to come up with that number.
You can also go on rental sites or Airbnb and see what other homes or facilities are renting out for to compare yours to those.
So to sum up the Augusta rule, the way to save is you rent your home out to your business. Let's just use $1,000 a day.
Easy number.
So that's $14,000 a year that you could put in your pocket, not have to report it, and then your business has an expense write-off of $14,000 a year as well.
It's almost like a win-win situation.
It's huge savings.
Right. We know that there are a lot of other tax loopholes that we probably should know about and that you should know about, but we really enjoy these 3, so we wanted to share them with you today.
If you enjoyed this video, make sure to hit that like button and subscribe to our channel.
If you have any questions about these, drop a comment below.
And until then, we'll see you on the flip side.